Hey there. Welcome to your deep dive into REITs and how they connect to inflation. We've got a really interesting list of sources here you gave me. Research papers, market analyses. We even have some historical data. It'll be fascinating to see what we uncover.
Looks like you really want to figure out if REITs can actually protect your investments from inflation. A lot of people are asking that these days, especially with so much economic uncertainty.
Yeah, exactly. And the sources give us a lot to work with. Some of these papers go deep, like analyzing how REITs perform during different economic periods, even the subprime mortgage crisis. And we've got some data on things like rental values, exchange rates, the whole nine yards.
It seems you want to understand how REITs work, but also their potential as a hedge against inflation. Let's start by breaking down what a REIT even is.
Okay, yeah, let's unpack this. REIT stands for Real Estate Investment Trust, but beyond that, I'm all ears.
Well, basically, a REIT is a company that owns, operates, or finances real estate that generates income. Think shopping malls, apartment buildings, office complexes, even data centers and cell towers are in the mix these days.
So instead of owning a property directly, you could buy shares of a REIT that owns a bunch of them. Interesting.
It is. And one of the big things about REITs is they have to distribute a big chunk of their taxable income to shareholders as dividends. At least 90% we're talking.
So that's where the appeal for investors comes in. You get in on the real estate action without having to be a landlord, and you get regular dividends. Sounds tempting.
It can be. And besides those dividends, there's also the potential for growth in the long term as the value of the real estate itself goes up. But like any investment, you got to remember there are risks with REITs too.
Right, no such thing as a free lunch.
No.
So tell me about these risks. What kind of things can impact how well a REIT performs?
Well, interest rates are a big one, especially REITs that own properties rather than just providing mortgages. They can be pretty sensitive to interest rates changing. When rates go up, their borrowing costs increase, and that can eat into their profits, maybe even lead to lower dividends.
Makes sense. So if I'm looking at REITs, I need to pay close attention to what's happening with interest rates.
Oh, absolutely. And it's not just about the rates right now, but what people expect them to do in the future. If investors think rates are going to go up, they might start selling off REITs, pushing prices down.
Gotcha. So interest rates, big deal. What else?
The other big thing is the overall health of the economy. REITs are tied to the real estate market, right? And that market is influenced by economic growth, whether jobs are being created, consumer confidence, all that. A strong economy usually means a healthy real estate market, which is good for REITs. But when the economy is doing poorly, things can get shaky for REITs.
Right, like during the 2008 financial crisis. I remember that was a rough time for real estate. What happened to REITs back then?
Yeah, rough ride for sure. Our sources show REITs across the board lost a lot of value. Their market capitalization just tanked. But the interesting thing is the impact was different depending on what type of REIT we're talking about.
Wait, there are different types.
There are. You've got equity REITs, the most common type. They own and operate properties directly. They're making money mostly from rent. Then you've got mortgage REITs. They don't own property, but they finance real estate owners and operators, making money on the interest spread. And then there are hybrid REITs, a mix of both equity and mortgage REIT approaches.
A real estate buffet. You can choose your flavor. But back to 2008, you said some REIT types were hit harder.
Yeah, mortgage REITs. They were really exposed to the subprime mortgage market, which, well, imploded. As borrowers started defaulting, mortgage REITs faced big losses. Their value dropped sharply.
So it's not just understanding REITs generally, but knowing the risks of each type. I'm seeing why people say REITs can be complex.
They can be, but that's part of what makes them interesting too. And it's why digging into the research, really understanding the details is important before investing.
Absolutely. Speaking of details, let's talk REITs and inflation. That's what brought us here today. Can REITs truly protect investments from inflation?
Right. Can they act as an inflation hedge? Hold their value, maybe even increase in value as prices of, well, everything go up.
I mean, real estate is a tangible asset. Seems like it should do well against inflation, right?
That's what people think, but the research we have shows it's more complicated. The sources really get into this, analyzing how REITs performed compared to different kinds of inflation, actual inflation, expected inflation, unexpected inflation. They use different measures like the CPI, treasury bill rates, the whole shebang.
Okay, I can already tell this is going to be complex.
Well, some research suggests that REITs, even though they're real estate, can act like stocks sometimes. They can even be what's called a perverse hedge.
A perverse hedge. Intriguing. What does that even mean?
It means their value goes down as inflation goes up. Might seem strange because we're talking real estate, but remember, REITs are traded on the stock market, And those market forces can be more powerful than the value of the real estate itself.
Ah, so even though they're based on physical assets, they're still playing by the market's rules.
Right.
But you said the research is mixed, right? What about the studies that do show REITs working as a hedge against inflation?
Yeah. Some studies found REITs might protect against some types of inflation, specifically expected inflation.
Expected inflation. So if you can predict accurately how much prices will rise, REITs could be good.
That seems to be one takeaway, yeah. But accurately predicting inflation, not easy. Even economists with all their data and models get it wrong a lot.
No kidding. So REITs and inflation, not a simple relationship.
Yeah.
Got to consider a lot. Interest rates, economic growth, the type of REIT, the type of inflation.
Exactly. And we're just scratching the surface. Even more to uncover when we look at the specific details within the research.
Oh, like what? I'm listening.
One study stood out because it found REIT returns actually went down along with inflation right after 9/11. Interesting question there. Why would that happen?
That is interesting. You'd think with all the uncertainty after 9/11, real estate would seem safe. But REITs underperformed. What's the explanation?
Probably a bunch of things, the economic slowdown after the attacks, investors changing their behavior, maybe even government policies in response to the crisis, all playing a role.
Right, the unexpected stuff can really mess things up, shows how complex and connected finance and economics really are.
Absolutely. And it reminds us even the best analysis can't predict everything.
Sobering thought. But it's why this deep dive is important. The more we understand these complexities, the better we can handle them, right?
Exactly. And we've got more to uncover. Remember that Livingston survey we mentioned, where economists tried to predict inflation? Well, the data from that shows something fascinating.
Okay, you got my attention. Lay it on me.
Economists were consistently underestimating inflation, especially in the years after 9/11.
Wait, so even the experts, with all their data and models, were getting it wrong?
Seems like it. And this consistent underestimation could have really affected how investors thought about REITs during that time.
So if investors were making decisions based on bad inflation predictions, that could have messed up their expectations for how REITs would perform. Important point.
It is, and it shows the limitations of relying just on forecasts and predictions, especially with something as tricky as inflation.
We've covered a lot, but I feel like I understand REITs and inflation much better now. Definitely more nuanced than I thought.
It is. But before we move on, there's one more bit from our sources. It's about rental values in Nigeria, how they relate to exchange rates.
Nigerian rental values. Seems kind of random compared to what we've been talking about. How does that connect to REITs and inflation?
Trust me. This might seem off topic, but it actually shows how global economics can impact real estate investments, even those that seem far away geographically.
Okay, I'm intrigued. Go on.
So, the source material gives us data on rental values for detached and terraced houses in Nigeria between 2010 and 2019. What's interesting is there might be a connection between currency changes and how well real estate performs.
Currency changes. Explain that one.
Well, during that time, the Nigerian naira dropped in value compared to the US dollar. Big devaluation. This had ripple effects across their whole economy, including real estate.
Yeah, I remember reading about that. Caused a lot of problems. How did it affect rental values specifically?
Well, the data shows a negative correlation between rental values and the exchange rate. As the naira weakened against the dollar, rental values tended to go down in Nigeria.
So a weaker currency could mean lower returns for real estate investors.
It's a possibility worth exploring. And this specific example is about Nigeria, but it makes a bigger point. Global economics, like currencies fluctuating, can indirectly affect even US-based REITs. Adds another layer of complexity.
Wow, this is making me think about REITs totally differently. It's not just the U.S. economy, not even just real estate. It's understanding how global markets are all connected, how things can ripple through investments.
Exactly. It emphasizes how important it is to be thorough when researching and analyzing REITs.
Absolutely. But before we get too lost in global economics, let's bring it back to you, the listener. What stands out to you from all this?
Are you leaning towards REITs as an inflation hedge now, or are you more skeptical?
I think what's fascinating is how REITs, even though they're based on something as tangible as real estate, are so influenced by interest rates, economic conditions, even global currency changes. It makes you realize there's more to it than meets the eye.
Exactly. And it makes you wonder, if REITs aren't always a reliable way to hedge against inflation, what other options are there? Maybe precious metals or a diverse portfolio with a mix of assets?
Good questions, and ones we'll have to explore further. But for now, We'll leave you to think about those possibilities as we wrap up part one of this deep dive. Stay tuned for part two, where we'll keep unraveling the mysteries of REITs and their place in the investing world.
Welcome back to our deep dive into REITs and inflation.
I'm ready to keep going. That last part really opened my eyes to how many things can impact REITs. It's like peeling back the layers of an onion.
It is. And speaking of layers, remember those research papers analyzing REIT performance during different economic periods? There are some specific findings there I think you'll find interesting.
Oh, I love getting into the details. What did you find?
Well, one paper goes deep on how REITs have responded to interest rate changes historically. Remember how we said REITs can be sensitive to rates going up? This paper actually puts a number on that sensitivity. It shows that when interest rates increase, REIT prices tend to fall, and sometimes pretty drastically.
So it's not just a theoretical risk, it actually happens in the real world.
Yep. And get this, the paper even breaks it down by property sector. Some sectors are affected more by interest rate changes than others.
Makes sense. I bet REITs focused on things like malls or office buildings take a bigger hit when rates rise. Those are big investments. Higher borrowing costs would cut into their profits.
You got it. Those types of REITs are more cyclical, meaning their performance is tied to how the economy is doing. When rates go up and economic growth slows down, businesses might need less office space or people might spend less. That leads to lower occupancy rates and less rental income for those REITs.
Makes sense. So those sectors are more vulnerable. What about sectors that are more resilient to interest rate changes?
Healthcare REITs are often mentioned as being less sensitive to those rate fluctuations. Their income tends to be more stable and predictable because healthcare is a necessity no matter what the economy is doing. People still need doctors and medical care even in a downturn.
Right. Healthcare is one of those things you can't really cut back on. So even if rates go up, those REITs will probably keep making steady income.
Exactly. That stability makes them more appealing for investors worried about rising rates. Of course, even within a sector like healthcare, there can be differences in performance depending on the specific REITs and what properties they own.
So the takeaway is understanding the little differences between property sectors is really important when you're thinking about REITs. It's not one size fits all.
Absolutely. And this connects to another thing to consider with REITs and inflation, the tax treatment of those dividends we talked about.
Oh yeah, taxes. Always a fun topic. How do taxes fit into all this?
Well, remember, REITs have to distribute most of their income as dividends to shareholders. And here's the thing, those dividends are taxed at your ordinary income tax rate.
That's not how capital gains from stocks are taxed, right?
Right. Long-term capital gains usually get taxed at a lower rate, which is better tax-wise. But with REIT dividends, you might have a higher tax bill, especially if you're in a higher income tax bracket. So even if a REIT is doing well and keeping up with inflation, those returns could be reduced by taxes, especially if inflation is high and pushes you into a higher bracket.
Exactly. It's not just about the returns on paper, it's about what you actually get too after taxes. And when inflation is high, taxes can take a bigger bite.
So we've got interest rates, different property sectors, and now taxes to think about. It seems like figuring out if REITs can actually hedge against inflation is getting more and more complicated.
It is, and to be honest, there's no easy answer. It all depends. The specific REIT, the type of inflation, your taxes, even your investment goals.
So thorough research and planning are key before jumping into REITs as an inflation hedge.
Absolutely. It's about making sure your investment strategy matches your financial goals and understanding the potential risks and rewards of each type of REIT.
Okay, we've covered a lot. Different types of REITs, how they performed historically, how they react to things like interest rates and inflation, even taxes.
And yet, there's one more interesting aspect of REITs we haven't talked about. Might surprise you. Ooh, I'm all ears. What else is there?
It has to do with how REITs are valued. Remember, they're traded on the stock market, just like regular stocks. And their prices are influenced by both the real estate they hold and investor sentiment and what's happening in the market overall.
Right, we talked about how even though they're based on physical assets, they still have to play by the market's rules. How does this relate to inflation?
One of the research papers brings up the liquidity premium. It's kind of technical, but basically it means investors will pay more for assets that are easy to buy and sell what's considered liquid.
Oh, okay. Like stocks that are traded a lot on major exchanges. Easy to buy and sell because there are always people wanting to make a deal.
Exactly. Think of it this way. If you had to sell something quickly, what would be easier, a share of Apple stock or a rare antique? That Apple stock is highly liquid. You'd find a buyer instantly. The antique could take weeks or months to sell.
I get it. The Apple stock is more liquid because there's a bigger market for it. So what does this liquidity premium have to do with REITs?
Research suggests REITs, even though they're backed by real estate, tend to have a lower liquidity premium compared to things like stocks.
Really? Interesting. Why would that be? REITs are still pretty easy to buy and sell in the market, aren't they?
They are, but a few things can impact their liquidity. For one, the REIT market is just smaller than the overall stock market. There are fewer REITs out there to trade, which means fewer buyers and sellers at any given time.
Makes sense. Fewer people playing the game means less trading activity. What else makes their liquidity lower?
Well, REITs themselves are complex. We talked about how they're influenced by all sorts of economic and market factors. That complexity can make some investors hesitant, especially those looking for a quick and easy investment.
Right, they might stick to more familiar things like stocks.
Exactly. And this lower liquidity premium can affect REIT performance, particularly when the market gets volatile.
So how does that play out in the real world? What happens when things get shaky?
Imagine inflation fears are rising, investors get nervous, they might start selling off their riskier assets, including REITs.
The classic flight to safety. Everyone wants to protect their money.
Right. And because REITs have that lower liquidity premium, this selling pressure can make their prices drop more than other more liquid assets. It's like trying to sell that antique during a panic. You got to lower the price a lot to find a buyer.
So that lower liquidity makes REITs more vulnerable to market swings, which could hurt their effectiveness as an inflation hedge, especially when things are uncertain.
Precisely. It's another thing to consider when you're looking at REITs.
This deep dive is really living up to its name.
Oh,
I had no idea REITs were so complex and interesting.
it is a fascinating world, lots of nuances and connections, and it takes paying attention to details and looking beyond the surface to really understand it.
You said it.
Hmm.
But I think we've done a good job of breaking things down so far. We've looked at different REIT types, how sensitive they are to things like interest rates and inflation, the impact of taxes, even this whole liquidity premium thing.
It's been quite the journey. I think we've given you, the listener, a solid understanding of what to think about when considering REITs as a potential inflation hedge.
Absolutely. But before we finish part two, I want to leave you with something to think about.
Oh, do tell.
Well, we've talked about how REITs are influenced by economic trends and market sentiment, but what about the other way around? Could how REITs perform actually tell us something about where the economy is going?
Interesting. Could REITs be a leading indicator of economic health? I think we need to dig into that more.
Stay tuned for part three, where we'll explore that very question and see if REITs can act like economic crystal balls. And we're back for the final part of our deep dive into REITs and inflation. We've really gotten into the nitty-gritty, haven't we? For the different types of REITs and their performance over time, to how they react to things like interest rates and inflation. And then right at the end of the last part, you brought up this idea of REITs maybe acting as economic crystal balls.
I did. It's an interesting concept, right? That REIT performance could give us hints about where the economy's heading. And there's actually some research that backs up that idea.
So tell me about that research. What did they find?
Well, one of the papers looks at the connection between REIT returns and something called real economic activity.
Real economic activity. Sounds
Yeah.
important. What exactly does that mean?
It's basically a way to measure the overall output and growth of an economy. Think of things like GDP growth, how many people have jobs, industrial production, that kind of stuff. All key indicators of how well an economy is doing.
Okay, so this paper looked at how REIT performance matches up with these broader economic indicators.
Exactly. And the interesting thing is, the researchers found a positive correlation between REIT returns and future real economic activity. In other words, REITs might be a leading indicator, giving us a glimpse into economic trends before they show up clearly in other data.
Wait, so if REITs are doing well, it could be a sign the economy is going to improve. Kind of like a canary in the coal mine, but for the entire economy.
That's what the research suggests. Of course, it's not perfect. The economy is super complex. There's always a lot going on. But this research does add another layer to how we understand REITs and their potential in investing.
This is totally changing how I think about REITs. Not just returns and inflation, but maybe a window into the economic future.
It is a different way to look at them, yeah. If you're an investor and you're trying to figure out where the economy's going, keeping an eye on REIT performance might be worthwhile.
So if I'm using REITs like economic indicators, what should I be looking for specifically?
Well, one thing is the performance of REITs in different sectors. Remember how we talked about how different property types react differently to changes in the economy? Same logic applies here. Like if industrial REITs, the ones that own warehouses and distribution centers, are doing really well, it could mean manufacturing and logistics are strong. That could be a good sign for the whole economy.
Makes sense. Or if retail REITs are struggling, maybe that means consumer spending is down, which could mean the economy slowing down. Each sector of the REIT market gives us a little glimpse into a different part of the economy, huh?
Exactly. And by putting all those glimpses together, we might be able to see the economic landscape more clearly and figure out where it's headed.
This is really making me appreciate how complex and connected the financial world is. It's like REITs are a piece of a bigger puzzle, helping us understand the whole economic picture.
That's a great way to put it. And like any puzzle, there are always more pieces to find, more connections to make. That's what makes investing so interesting and challenging.
Couldn't agree more. And on that note, I think it's time to wrap up our deep dive. We've gone deep into REITs, their tricky relationship with inflation, and even thought about them as potential economic indicators.
A real journey of discovery, full of surprising insights and new ways of looking at things.
It has been, and I hope it's encouraged you, the listener, to keep learning about REITs. Do your own research, ask questions, and come to your own conclusions. Remember, knowledge is power, especially when it comes to investing.
Well said. And with that, we'll leave you to consider all the possibilities. Happy investing.